All right. Today is Monday, September 4th, and this is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight. Happy long Labor Day weekend. Hope you had some rest and you're going to come back fresh with new perspective, that kind of stuff. And hopefully you're not stuck in Burning Man. Let's go listen to music and get stuck in mud. No thanks. That's not fun. My idea of fun is you had a great holiday weekend. You're now relaxed and focused and maybe a little high. Are we getting deeper into the evening and the kids are asleep? Your significant other is locked in whatever other room they're in right now. You're sitting here, you're watching the Maverick Wall Street with an adult beverage, maybe a little bit of popcorn, maybe a cheese and cracker platter with a little bit of salami. But that's my idea of fun. So let's get started here, folks. And the conversation throughout this shortened trading holiday week was, look at the chart here. You're looking at the SPX daily chart, S&P 500. We began the week with a massive bearish engulfing candle from the week before. And bearish engulfing candles usually indicate strong rejections and more downside to come. However, if we see the chart trading and closing above the top of a bearish engulfing candle, then technical analysis teach us that this is what it's called bullish reversal, which means you should be buying right now, you should be buying the stock market because the worst is behind. We have passed the obstacle. We have a bullish reversal. So the question throughout the week was, why aren't you buying it? Why aren't you folks believing all of this? Because you can say, okay, Maverick, you're a perma bear. You're never going to buy the dip anyways. But what about you? How come you're not buying this? Because I heard maybe 3 guys who said, yeah, we're buying it. But the rest, they're not even going to touch it. So what's the problem here? Let's take it one step at a time. Throughout the year, we've been talking about the massive divergence between the bond and the stock markets. We can look at the S&P 500 versus the inverted chart of the 10-year yield, or in this case, we can use the valuation, the forward PE ratio for the S&P 500 in blue, or we can use the inverted 10-year yield in white, or we get pretty much identical results. So when we look at this, you can see that we have positive divergence until recently, when we opened this massive gap. And in the past, when we've seen such a massive gap between the stock and bond markets, it usually resulted in phenomenon such as Volkswagen in 2018 and the crash in 1987. We covered that in details in last weekend's video. But here, when we look at the chart, in orange, you can see the E-mini futures for the S&P 500, the stock market. And in white, we can see the 10-year yield. I'm going to remove the coloring here just to show you something. So we have a black and white chart now. You can see that during the divergence, when we were complaining about, hey, wait a minute here, the stock and bond market yields are going higher together. That doesn't make sense at all. So we can see positive correlation here. And then in the month of August, we resumed the negative correlation that we've been used to for years now, for decades really. And we can see that when the 10-year yield went higher, equities in orange went down. And then of course, we fast forward to this week's activity. And what do we see here? We see once again the 10-year, at least on Friday, went higher, along with it appears to be the stock market too. So what's going on here? We talk about why so many are doubting this rebound. Who do you trust here? The bond market on Friday popping higher, or the equities market moving higher? One of these two is lying again. And then we look at the steepening of the yield curve. So in orange, you have the 2-year versus the 10. And every time we see the 2 gaining over the 10, we see inversion of the yield curve. So when the orange line goes higher, we see inversion of the yield curve. You can see that the stock market loves the inversion of the yield curve. But the stock market freaks out when we see the 10-year gaining over the 2, aka steepening, because it indicates that perhaps the economy is indeed getting damaged, and we will see change in the monetary policy. To accommodate for what? To accommodate for a recession. And therefore, every time we see a steepening of the yield curve by the orange line moving down as the 10 gains over the 2, we see equities moving down. With the exception, of course, of this week's activities when, at least initially, we saw the yield curve inverting again. And in response, we saw equities rebounding and moving higher. But then came Friday, and we saw a massive steepening of the yield curve. But the equities market did not respond. The equities market did not go down. So what's going on here? Another illustration for you, we look at the E-mini futures, the SPX, the S&P 500 in orange, and we look at the Dixie, the dollar index, in green. And just to illustrate for you here, we take the colors out. And you can see that when the Dixie moves higher, we see the equities market moving down. When the Dixie moves down, we see the equities market moving higher. You can see this correlation again. The Dixie moving down since the SVB collapse, and we see equities moving higher. Until recently, we saw the Dixie moving higher, equities moving down. Now, what about this week? Here it is. The Dixie initially went down and equities moved higher. But then on Friday, it did recover pretty much fully. But the equities market did not register any response at all. It should have been down if the correlation holds. So again, what's going on here? We talk about all of these suspicions and the doubt that folks are throwing on this rebound. And to understand all of this, we have to go back before the week even began. August 27th, I issued this tweet saying that the next jobs report will show the beginning of real weakness in the labor market. And then the next CPI will show that inflation continues to recover. Prepare your ears to hear the word stagflation a lot. Now, the problem is we heard the word stagflation on Friday on CNBC a little bit in an exchange between Rick Santelli and Steve Leisman. Take a look.
Yeah, I think the best way to summarize the markets from the Treasury standpoint is to show a two-day chart of the spread difference between a 10-year rate and a 2-year note rate. Right now, that's around minus 68. But yesterday, right before the session started in the mornings, before it came in the New York time zone, it was minus 87. This is a huge move. Huge move, and it underscores that right now we're at 417 in a 10-year. That was hovering at 407, 408 right after the number was out today. It closed at 424 last week. It's getting very near unchanged, whereas a 486 is last in twos. They closed at 508 last week with a double top going back to March when we had a close of 507. So I think that the movement in interest rates summarizes what's going on. What I hear when I look at that trade is that we have a bit of stagflation in somebody's minds there. And real simply, before Steve takes over here, the 110,000 revisions to 2 months, let's put a face on that. That means June was 105,000. That sounds pretty small, doesn't it?
I like what Rick is saying. Not as far as it goes, though. I'm not sure there's a stagflation trade in here. It may be just a renormalization, because what should be happening is the short end could be cooling, at least relative to the long end, in anticipation that the Fed is done here. I think the Fed had a pretty good week here.
So I'm going to cut it right here because Steve Leisman is going to prop up the propaganda for the Fed. In the beginning of the week, he said, bond yields are going down because the jobs market is cooling, as we saw job openings going down below 9 million for the first time since 2021. And maybe we're seeing the soft landing. Mission accomplished by the Fed. This is why we're seeing yields going down and the equities market going higher. Then came Friday when bond yields shot up significantly higher. And Rick Santelli is now suggesting that maybe we have stagflation going on, which has been my thesis for a long time now. And I think the reaction on Friday by the bond market, and most importantly by the dollar, indicates that we are indeed heading into stagflation. But Steve Leisman now says, maybe it's just the normalization of the bond yield curve, whatever, because they're going to spin everything into, the economy's doing fine. We have a booming economy right now. Inflation is not a problem. The Fed will not have to raise rates anymore, and just put your blindfolds on and continue to buy the stock market. That's their objective at the end of the day. But the facts disagree. The week began with what it appeared to be bad news for the economy. Job openings down. That's bad, but the stock market looks at it as good, because if the labor market is cooling, then maybe the Fed is done with the tightening campaign. That's what the market really cares about at the end of the day. It's a drug addict to the Fed's cocaine. More liquidity and lower interest rates. And the market looks at a headline like this and says, okay, maybe inflation is over, maybe the job market is cooling, and we have a recession coming, maybe a mild one, not a really big one. And this will push the Fed to cut rates. And we should buy equities right now, because when the Fed cut rates, bond yields go down, and that enables equities valuations to be expanded. And of course, job openings did not go down without quits also going down. So the labor market is indeed tightening. And then we got the revision to the GDP, and the GDP was revised down. Another piece of bad economic news. But again, the market looks at that as, but that's good for the stock market because the Fed will have to cut rates, and then we can expand valuations again. Then came the ADP report for the private sector confirming all of this. The headline reads, U.S. job growth slowed sharply to 177,000 in August. The expectations were for 200,000. So again, confirmation of weakness in the labor market. So far, so good, at least for the stock market. Then we got Friday's payrolls by the Bureau of Labor Statistics, and it came a little hotter than expectations, but it is still a downtrend since 2021. So for now, no alarming signal here. It actually confirms that we have some weakness in the labor market at least. And of course, Most importantly, the kitchen is now revising previous job numbers by 110,000 jobs in the months of June and July. So 110,000 jobs, fake jobs, were just cooked in June and July, and now they're taking that out. In other words, the labor market might be really weak now, might be weakening really rapidly. And we see that the unemployment rate moved higher to 3.8%. Now, some would argue that this is because the increase in labor participation rate, as we see folks running out of savings and rushing to take jobs, whatever jobs they can get their hands on. So we see the unemployment rate moving higher. Again, all of this is bad economic news, but the market looks at this as, okay, great news because it pushes the Fed closer to ending their monetary tightening campaign, but most importantly for the market, issuing new stimulus and new rounds of cocaine by cutting rates and re-stimulating the market. Of course, the market is absolutely mistaken about this assumption, 1,000,000%. But here's the bigger problem. We go back to my tweet because I predicted that we're going to get pieces of data, be it the payrolls, be it the ADP, be it the JOLTS, doesn't matter. Actually, all of them confirmed that we have weakness in the labor market. That was part number 1 of the tweet. Part number 2 is what really matters. Is the jobs market weakening and inflation is also going down? Then we can argue that we have a soft landing. Some would argue that this is a beginning sign of a recession, but we can have that debate all you want. Team soft landing versus team recession. What I care about is inflation really going down, or is inflation about to rebound as the labor market weakening? In the next part of the tweet, I said, and then the next CPI will show that inflation continues to recover. Prepare your ears to hear the word stagflation a lot. Now, stagflation happens when the pace of economic activity in the economy slows down, but the pace of inflation stays sticky or moves higher. So we have a combination of higher inflation and weaker economy. That's called stagflation, and it is the nightmare scenario for the economy, for the stock market, and the Fed, because if we have a recession and a market crash, then inflation is crashing too, and the Fed will cut rates and re-stimulate the market, re-stimulate the economy, and here we go again. But in the case of stagflation, we can see weakness in the labor market, we can see stock market crashing, but the Fed will be handicapped from doing anything to rescue here. And the reason is they still have higher inflation. So here's the reminder. The equities market in orange and the 10-year bond yield in white. These should be moving in opposite directions. As bond yields go higher, the equities market should go down. But this week, what we've seen is bond yields went higher, equities market did not go down. And now the pumpers have another spin for it. They say, oh, the yield curve is now steepening, and it's good for the stock market too because it means that the Fed is done. It means that the economy is now about to grow. The Fed is out of the picture, and we're seeing bond yields steepening in a bullish manner. These zombies of BMO say that the 10-year Treasury bond is screaming buy because the Fed has regained credibility on fighting inflation. Oh, wow. Here's the problem. If the yield curve was steepening in a bullish manner and inflation is gone and the labor market is now weakening, we should be seeing bullish steepening, not bearish steepening. In bullish steepening, we see both the 2-year yield and the 10 going down together, but the 2-year going down at a faster rate than the 10, and hence we see steepening of the yield curve. And that's called bullish steepening as yields go down altogether, but the 2 at a faster rate than the 10 and the 10 at a faster rate than the 30. Bearish steepening happens when both go higher together, but the 10 accelerates at a faster pace than the 2 and the 30 at a faster pace than the 10. And this is what we saw on Friday. Bearish steepening, not bullish steepening. And folks, we haven't even gotten the CPI, but this week we got a lot of teasers saying that, yes, the jobs market is weakening, but inflation is about to go higher. It's actually recovering. We have a confirmation of stagflation in the economy. You see, in the payrolls that we got on Friday, weekly wages actually ticked up higher. Hourly wages did not go down by a lot. We also got the PCE inflation rate, and we saw a rebound in both the headline and the core PCE inflation rate. Also this week, we got the manufacturing PMI. And in that report, prices went higher by 5.8 points. That's an acceleration of prices paid. So we see inflation moving higher in the economy now. And also, according to the Case-Shiller Home Price Index, U.S. home prices rose in the month of July after 5 months of declines. So we see inflation rebounding as the labor market is weakening. Once again, that is stagflation. And this is why we're going to see bond yields going higher, along with the dollar, And what would the equities market do in this situation? Because their assumption of a soft landing, their assumption of, oh, the labor market is weakening, but also inflation is weakening, is pretty much wrong. And what they have instead is a stagflation phenomenon in the economy. See, the Wall Street Journal says, jobs or inflation, which will cool quicker? Question mark. The economy's ability to skirt a recession depends on the jobs market not cracking before the Fed is satisfied its inflation fight is ending. This is the $1 million, $1 trillion, $100 trillion question. Is the jobs market cooling faster than inflation or not? Because if the jobs market is cooling but inflation is gaining steam, that is the worst case scenario. That is the nightmare scenario for the Fed. And that is stagflation, and that's the nail in the coffin of the delusional morons who are calling for a soft landing or mission accomplished, or saying that we have a bull market right before stagflation and a recession. And that could result in a 1987 crash rapidly as the adjustment starts to kick in, as the assumptions are now ratified. And folks, I said this all along. July 9th, I said that the next move in oil prices will stun the Federal Reserve, especially that tool Goolsbee, who infiltrated the Fed on behalf of banksters. By the way, his wife pretty much got him the job. The guy was sitting at the couch eating potato chips and drinking beer all day long. She wanted to get rid of him. And she used her connections to get him in the Fed. And his job is to put a pause, slam the brakes on Jerome Powell, stop him before he gets rates, as they should, higher for longer, to beat inflation, because the result of that would be a lot of banks will fail. But anyways, we can talk about this in another video. The point being here is, oil is moving higher. I mean, all you have to do is just look at the pump, what you're paying right now. Look at the chart of crude oil. It is recovering. And we know from the supply side, the Saudis are not going to relent. They keep cutting supplies because they need these prices higher for longer. Their economy is about 90% plus dependent on oil. And if the green transition in global economies is about to make crude oil obsolete, well, the Saudis are not just going to sit there and say, okay, yeah, let's go extend here. They're going to fight. They're going to do whatever it needs to be done to keep these prices higher for longer, to transition from an oil-dependent economy to whatever they want to transition to. And we see that shipments of Saudi crude exports are actually going down. So the supply is now tightening, and we talked about the SPR. The SPR will have to be refilled and replenished at some point, and maybe the Biden administration now missed their point or missed their opportunity twice this year when oil prices were around $70 on the WTI. And we have a lot of indicators right now that the Biden administration is freaking out, and they're secretly refilling the SPR using the prices that we have today, not the $70. Or they're paying $80, $85 now, because they know that prices can go significantly higher from this point on. So sure, you can say, oh, China is in a recession and Chinese demand is out of the picture, oil prices should be down. But you combine these supply cuts by the Saudis and the Russians with the replenishment of the SPR, with the demand in India, with the domestic demand still hot, and you have a picture that could push prices significantly higher. And if we have energy prices moving higher, along with a weakening labor market, what do you call that? Stagflation, baby. And you can see that the XOP, this is the oil ETF versus the SPX, this is the S&P 500, the market. We can see that oil stocks are now resuming their leadership over the stock market, just like we saw back in 22. And that was not good for technology stocks. That was not good for the economy, because when energy stocks lead, it indicates that inflation is moving higher in the economy. And I know what you're going to say, but Maverick, yes, inflation is sticky and energy prices are moving higher again, and we might see inflation rebounding. Sure, we got all of that, but we're not seeing a disaster here in the labor market. We're not seeing job losses for you to say that we have stagflation. All what we're seeing in the jobs market is cooling down. And that should be good, right? How about wrong? I'll tell you why. Prepare yourself to see job losses in the near future, combined with higher inflation. Why do we say that? Look at this chart from Tavi Costa about U.S. ISM manufacturing. Consecutive months below 48. This is the recession reading. Every time we've been this long and this high in readings below 48 in the manufacturing ISM reading, we got a recession. We got a crisis of some sort. So we know that there is huge economic weakening and a huge economic event that's about to show up here. Most importantly, when we talk about the resiliency of the economy, they all talk about the consumer, or the consumer is so resilient. And sure, we might have weakness in the jobs market, inflation sticking higher, but the consumer will keep this economy afloat and prevent a stagflation crisis. Well, when we look at U.S. personal savings, they're crashing down. The consumer is digging deep into their savings to cope with inflation, to pay for Taylor Swift, about $5 billion. And now we got Beyonce on top of that. You got OnlyFans with another $5.6 billion. Billion here, billion there. All of that is sucking out the liquidity out of the system from the hands of the consumer to the hands of Taylor Swift, to the hands of Beyonce, to the hands of the executives and the oligarchy when it comes to the stock market, because that's yet another bubble meant to suck the liquidity away from the consumer. We see the phenomenon of savings going down and credit card debt moving higher. And oh, by the way, when we talk about sucking the liquidity away from the consumer, it's not just Taylor Swift or Beyonce. We now have the resumption of student loan payments, billions and billions of dollars. That's going to tighten the screws in the consumer even more. When we look at delinquencies, they're popping higher now. At the highest level since the Great Recession back in 2008, consumer delinquencies on all kind of debt are moving higher now. Auto loans, credit cards, consumer loans, all moving higher. We look at deposits at commercial banks. They're collapsing again. We have no recovery here at all. The banking crisis is not over yet. As the consumer, they have to pay for student loans now. They have to pay for credit cards. They have to pay for inflation. So we see deposits coming out of banks, and as interest rates continue to rise higher in the economy, more and more deposits are moved away from banks into CDs, into money market funds, into T-bills, as these rates pay you significantly higher than any savings account. So it's just tick-tock here, folks. It's just a matter of time before we see banks blowing up again, until and unless the Fed cut rates. But the Fed will not be able to cut rates with inflation sticking, and oh, by the way, about to move higher again. And even when they try to put a spin on it, they can't really. They're making an ass out of themselves because the facts go against them. Take this headline from Yahoo Finance, for example. It says the middle class is getting its spending power back, but progress is fragile. What are they talking about? Here it is. A new household budget index from Primerica, a financial services company, found that the purchasing power of middle-income households, defined as those earning between $30,000 and $130,000 a year because, they live similar lifestyles, increased to 97.5% in July, up from 97% the month prior. Yay! We're getting richer, baby. Here's the catch. The improvement, however, is still below the index's baseline of 100% that occurred back in January 2019. Any reading under that threshold shows consumers' spending power is at a deficit. Whoops. The modest uptick comes after credit card debt surpassed $1 trillion. Uh-oh. Another whoops. For the first time last month. And a string of recent data showed that more consumers are having trouble paying their debts on time. Uh-oh. Whoops. Once again, credit card balances hit $1.03 trillion, up 4.6% from the previous year, the Federal Reserve of New York revealed earlier this month. Similarly, the Federal Reserve of St. Louis reported outstanding credit card balances had surpassed $1 trillion. Both indicators were record highs. Booming economy, you say. A separate study found that 51% of credit card borrowers could not pay off their entire balance each month and let debt roll over from one month to the next, accruing interest. Bidenomics, baby. That was the first time that the share of Americans revolving their debt was higher than those paying off their bills on time.
Oh, no.
Uh-oh. And Macy's said last month its second quarter credit card sales were down 36%, with the retailer writing off many of the ballooning balances of consumers unable to pay their bills. It wasn't just Macy's. It was Nordstrom, it was Dick's, it was Best Buy. Many companies, many retailers are saying that consumers are now getting delinquent on their credit cards. Most importantly, when that interest keeps moving higher, what happens to the purchasing power of the consumer? Here it is. For folks with revolving credit card debt, accruing interest can add up fast. For instance, if you have a credit card with an APR of 20.60% and want to pay off $3,000 in debt within 24 months, you'll pay $153 monthly. Over that time, you'll accrue roughly $685 in interest. That is cash you could be using for other expenses. And listen to this, a survey conducted by TransUnion between April 21 and September 22 found that borrowers who used a personal loan to consolidate their credit card debt saw their balances decrease by 57% on average. But for many, listen to this is really important. Those balances returned close to their previous levels 18 months later. Researchers from LendingTree found similar results, with borrowers again starting to pile on credit card debt only 3 months after consolidation. The data underscores what seems like a growing debt problem for many Americans, as total balances hit all-time highs. Interest rates remain north of 20%, and delinquencies start to tick up. And of course, worsening the financial circumstances for many younger Americans is the end of federal student forbearance comes October. According to Experian, the average student loan borrower will have to make a payment of $203 once payments resume. In summary, folks, we're getting closer and closer and closer to a prevailed winner in this battle we've seen since the year began. If you've been on the bullish side in either team soft landing or team pivot, you've been arguing that, equities are going higher because inflation is cooling down and the Fed is getting closer and closer to ending the tightening campaign, and we're not seeing any damage in the economy. If you happen to be in the bearish side, you've been either arguing for a recession right away or a stagflation, then a recession. And this month, we've already gotten the data suggesting that the labor market is weakening, and we know that the economy has been weakening for a long time now. All what we need is a piece of data that shows that inflation is not going down along with the weakness of the economy. In fact, inflation is actually rebounding higher. Once we get that piece of data, it's over. It's done. Team stagflation wins, the market crashes, soft landing hopes go out of the window, and we're going to see a reckoning like you have never seen before. But that doesn't mean that we don't have an opportunity here. Under stagflation and a prolonged period of higher inflation and a weaker economy, we see financial assets underperforming real assets. Real assets been crashing for years now, for decades really, and they're really cheap at this point. Stagflation will appreciate the prices of commodities, real estate, real assets, but it will crush the valuation of financial assets, aka the stock market. So don't say that you haven't been warned. We're getting closer and closer to the grand finale. But until then, folks, we have to move on and cover the stock market information for you. We begin with the closing of the indices last Friday, and here we go. The Dow Industrial Average closing positive by 115.80 points, or a gain of 0.33%. The Nasdaq closing negative by 3.15 points, or a loss of 0.02%. The S&P positive by 8.11 points, or a gain of 0.18%. We look at the sectors on Friday at number 1, capturing the gold, the silver, and the bronze because of the relative outperformance, surpassing all of them really by a mile, energy. Then you got metals at number 2, you got financials at number 3. So a little bit of a stagflationary theme. When we look at Friday's activities, we have energy, we have metals higher, then we have utilities and defensives down because yields are moving higher. We're talking about yields on T-bills. And if you have the risk-free rate moving higher, why would you even bother with the dividends from utilities or defensives? When we contrast this with the performance for the week, what do we see here? In the beginning of the week, we saw the dollar moving down, we've seen yields going down, and this enabled risk on in the stock market. It was a soft landing theme, at least in the beginning of the week. We see technology, we see communication services moving higher. We see metals at number 3 because the dollar went down, at least initially for the week. But then again, you look at the laggard for the week, utilities. Utilities been telling us for a long time that yields on bonds are going higher. And we don't see the end of that yet. When utilities start to outperform the S&P, then we're going to start to talk about, okay, rates are going down and therefore we see utilities are going higher. But that's going to be for the wrong reasons. That's going to be for the recession. And that's why we see utilities and defensives doing pretty good under a recession. High dividend paying names, they do pretty good when yields go down, when the economy dips into a recession. We'll look at the breadth on Friday. NYC 70% advancing versus 28% declining. The Nasdaq 62% advancing versus 35% declining. So we have a little bit of an elevated breadth here on Friday with 70% advancing on the NYC. Yet you have the dollar moving higher along with yields. I think we have an adjustment coming this week. As we see traders coming back to the desk and looking at yields and saying, okay, what got us in trouble is yields going higher, the 10-year moving higher, the 30 moving higher. What we got on Friday is yields moving higher again. So maybe we should book some profits here from the algorithmic trading that took place when we were away from the desk and the computers did all of the trading. We thank the Lord, we book the profits, and if that is the case, we see a pullback this week. We'll look at commodities and the closing on Friday. What do we see here? Stunning move in crude oil here, be it the WTI or Brent, up about 2.5% apiece. And then you got the gasoline RBOB up about 1.5% on Friday. You got metals, copper up about 0.75%. You got in softs, sugar futures up a little over 3% on Friday. Cotton futures up about 2.5% on Friday. Then you got in grains, soybean oil and corn moving higher. Sure, we have decliners on Friday in coffee and OJ futures and all of that. But all of these gains came despite the fact that the dollar moved higher. We look at the weekly performances. What do we see here? WTI up over 7.75%. Crude oil Brent up about 6%. All of these gains, folks, are happening in a single week. We talked about it in this channel before, that inflation is not over and the move by crude oil is going to stun everybody, including the Fed, and you see it right here. The WTI up almost 8% in a single week. Can you really say that we have a soft landing? Can you really assume that inflation is dead? Of course not. Inflation is coming back as we see weakening in the labor market and the economy. That's called, once again, stagflation. We move on to the options market, the big casino. What do we see here on Friday's activities? The volume is down all in all, so we know that it's not a surprise really because we have a holiday weekend, but the volume went higher in names such as Tesla, Nvidia, Apple, and mostly in favor of buying calls. So we still see the mentality of buying the dip, and maybe if this week was a trap, then a lot of folks got trapped here. Because they bought calls, they assumed that this is over, the rebound is for real, and higher we go from here. And then what do you know? The holiday is over. We come back, we see bond yields higher, we see the dollar higher, and we see the equities market down. And we resume doing what? Buying put options. So I would say that a lot of signals that we got from this week could be false, including the demise of the VIX. Keep that in mind. What about the unusual activities that took place in the options market on Friday? We begin with none other than Tesla, the souffle. And in this case, the souffle was down big on Friday, but it gained a lot throughout the week. So the problem here is the chart. Something really significant took place on Friday. We'll talk about that in a minute, but here we have somebody bidding for more pain to come. They bought the 232.5 puts for the expiration date, September 15th, with expectations that the name will go down and lose more than 5% of its value by then. Paid about $3.25 a piece to enter this trade, all in all, spending about $2.8 million. Then we'll look at the Qs and the SPY, and again, I'm not going to cover this trade, but it's really interesting that somebody's betting on a crash when we open tomorrow. Somebody's betting that the Qs will go down by 10%, the SPY will go down by 6.5%. It could happen, folks. If the computers look at the action that we got on Friday as, whoops, let's do 1987 again, or volume getting, because yields are going higher, equities are going higher, you gotta sell here. If the computers do that, comes this morning, I'm not sure that's going to be the case, but somebody here assumes that maybe it's going to be. It's worth taking a shot. So you can read the mentality here by market participants. The trade is not really that important. Maybe the crash is not going to happen. But most importantly is what traders are eyeing right now. They're eyeing a crash, and they're starting to bet on it. We'll look at the ticker W, Wayfair. And somebody here is betting that the name will go down or lose more than 17% of its value by the expiration date of October 20. And they bought the $60 calls. If we look at the chart of W, what do we see here? When we look at the daily chart, maybe a possibility of a topping head and shoulder pattern, perhaps. And this is why the trader bought the $60 puts for the expiration date October 20. They paid about $1.50 a piece to enter this trade, all in all, spending about $1 million. And then we have the ticker GTLB for GitLab. And here somebody sees a big rebound coming, big move higher coming for GTLB, and they bought the $60 calls for the expiration date, September 15th, with expectations that the name will move higher and gain more than 22% by then. Paid about $1.25 a piece to enter this trade, all in all, spending about $1.3 million. We'll look at the heat map on Friday. Again, it's a mixed picture, but it's really interesting to me that we see energy and metals moving higher. We can say that's a stagflation theme. Of course, inflation is moving higher, but what about the Chinese names? Alibaba, Pinduoduo, JD moving higher, but the dollar moved higher. So we have conflicting moves here. Dollar moving higher, we should see Chinese equities going down. We should see metals going down. We should see at least gold going down, because we know that gold is the old man in the room and it's mature. It's going to follow the dollar. It's not going to play cute games. It's not going to fight the Fed. It's not going to fight the dollar. So we see gold miners down. Really interesting here. Then we'll look at the rest of the market, mostly positive, nothing to see here. We see the crowd's favorite names, Nvidia, Broadcom, Tesla, going down big on Friday, so maybe profit taken here. Then you look at the staples, consumer staples, down big on Friday. So we see a response to the rebound in yields when it comes to defensives, but not really in technology, not really in banks. Banks were in the green. So a lot of conflicting messages here, but we can't really do anything about it. We have to see how the market is going to receive and digest all of this information comes Tuesday. But you look at communication services, we know what's going on with Disney and Comcast, so we saw both of them down. But besides that, we can't make anything here from the action on Friday. We'll look at the action for the week, mostly in the green, and the reason is Monday, Tuesday, Wednesday, Thursday, yields went down, the dollar went down. So what do we see? Risk on. Technology rebounding big. Apple, the big caps, the AI mania, all moving higher. Cyclicals, industrials, even energy and metals moved higher. Banks, everything moved higher because yields and the dollar moved down. But then yields rebounded on Friday and crushed utilities, which was an underperformer to begin with. So utilities was kind of predicting that, hey, I don't trust the drop in yields here. And then Friday was a massacre in staples. So we see staples underperforming for the week. Again, mixed messages. Do you trust utilities and staples, or do you trust banks, big cap technology stocks, the AI mania cyclicals that say, oh, yields are going down? Which one do you believe? Until the resolution happens, what about the heat map for the ETFs for the week? Again, sea of green across the board. Yields are down, at least all the way till Friday. Dollar is down, at least all the way till Friday. And we see pretty much everything is higher. The exceptions, of course, are notable. The yield-sensitive names, the high dividend-paying names, XLU, utilities, XLP, staples, XLV, healthcare. Those did not go higher. Those are saying, watch out, we don't trust and we don't buy the drop in yields. We think yields are going higher on the 10-year, the 30. And again, what do you believe? Let me know in the comments. Do you believe chips? Do you believe KRE? Do you believe energy? Do you believe the home builders? Do you believe the Chinese equities, who all say that the dollar and yields are going down? Or do you believe the message from utilities, staples, and healthcare? Let me know in the comments. But folks, let's do some charts here and then wrap it up. And a reminder, we did the charts to watch marathon for the members, so please check that out. Lots of charts, individual names, ETFs, so go check that out. But we will look at the SPY, the S&P 500, an hourly chart for the S&P 500. What do we see here? The answer is on Friday, we got a gap and somewhat of a crap here. So some would argue that we got a response to the rise in yields in the dollar, which was the gap and crap. But I would argue that if we've seen the magnitude of the move in the dollar, for example, in let's say Tuesday, Wednesday, or Thursday, I think the market should have been down about 2% or so. But on Friday, right before the holiday, nobody's trading and the volume is low, we did not see such a response. There were conflicting messages. We'll see how the resolution is going to play out comes Tuesday and in the remainder of the week. But for now, the bears could argue that this is a bear flag pattern. And at some point, we have to go down and retest what? Retest the top of the bearish engulfing candle. We broke above it, but since nobody trusts the breakout, we have to go down there and retest that level of support. And if we pass, then the doubters will have no other argument, at least from a technical standpoint. But so long as the market keeps going higher, as yields and the dollar keep going higher, then doubt will continue to grow. We'll look at the E-mini futures, the daily chart. What do we see here? Once again, we passed the top of the bearish engulfing candle at around 4,500. We're now consolidating in what it appears to be a bull flag pattern. You can throw cold water on that if we lose 4,509 overnight. But until then, it's a bull flag pattern. The chart wants to go higher. But here's the problem. If you believe that this is a trap because yields and the dollar are going higher, are we going to see a response in the opposite direction? Then you can be supported by the weekly chart. If we take a look at that one using the Fibonacci retracement levels, what do we see here? We got a retracement top to bottom to about the 78% line. And it appears right now that the chart is facing some resistance. You look at the RSI, we are in negative divergence. You look at the MACD indicator, we have bearish momentum in the histogram. And this could be a trap if we form an inverse ABC pattern. And what about the cash index, the SPX daily chart? What do we see here? We're above the 20, we're above the 50. All of these are bullish indicators, now bearish. The RSI, the MACD indicators on the daily, they're all in positive momentum. Again, bullish, now bearish. So what's not to like here? We go back to the conversation. Why are folks doubting this breakout? It has all of the check marks of a classic bullish reversal. So what is the lack of love coming from? Maybe folks would argue and say, look, the 20 moving average moved below the 50 and that could be a bearish signal that this could be a trap. Actually, if we go back and we zoom out of the chart, we can see that we've seen crossings where the 20 moves below the 50 multiple times this year and in 22. And it's a mixed bag. Sometimes it indicates a bottom, sometimes it indicates more pain to come, as you can see from the chart. So that is inconclusive right now. The chart says I want to go higher, and there is little doubt that you can throw from a technical standpoint alone. You can throw in the fundamentals, you can throw in the bond market, you can throw in the dollar. But until we see the reaction that this was indeed a trap, for now, the technicals say the chart wants to go higher. We'll look at the Qs, an hourly chart. What do we see here? We got somewhat of a gap and crap. Not a rejection yet or a reversal yet because we lost 380 as the dollar popped higher along with yields in the morning, but the chart closed above 376. Now, if the action on Friday was a throw-off and we have perhaps maybe a gap down in the morning, for whatever reason. Can you support that by something you see in the chart right now? Maybe you can if you argue that this is a pattern of higher highs and used to be higher lows, and now we formed a lower low. And next thing you know, it's going to be a lower high, or we get an inverse ABC pattern, or we go down in a retest of the top of the bearish engulfing candle. Maybe that is the case, but we're not going to have a confirmation of that until we lose 376 as support. And the chart will not become bearish again until we lose the top of the bearish engulfing candle at 372.74. We look at the daily chart for the continuous contract for the NASDAQ. What do we see here? Once again, we closed above the top of the bearish engulfing candle. That is bullish, not bearish. The momentum indicators, the RSI and the MACD are all positive. That is bullish, not bearish. We have a consolidation above 15,500 in a bull flag manner. That is bullish, not bearish. But again, nobody's loving this. There's a lot of doubt. Oh, it was a low volume week. It was insignificant, or the dollar is moving higher, or yields are moving higher. And I think folks are not going to feel comfortable in buying this until we see a new high in the series. Otherwise, you can look at the weekly chart for the continuous contract, for example. We use the Fibonacci retracement lines. We can argue that we have a negative divergence on the RSI. We can argue that we're facing resistance right now, and maybe we're forming an inverse ABC pattern. And this is why the action we're about to get this week could be really decisive. It could confirm that the top is here. It was already in August. That's the top, and down we go from here, if indeed we get a confirmation of an inverse ABC. We'll look at the NDX daily chart. You can see that we have a sloping line of resistance, and now we broke out of this sloping line. Is that bullish or bearish? The answer is it is bullish. You look at the RSI, the MACD indicators, both in positive divergence, both showing positive/bullish momentum. Once again, that's bullish, not bearish. Here's the problem. If we plug in the Bollinger Bands, the moving averages, we can see that we pretty much filled the gap here, yet we're trading above the upper Bollinger Bands, which means we have a pullback coming. Now, the pullback can take us all the way down to the 50 MA. If we rebound and move higher again, so far so good. If we cut the 50 and we go down to the 20 MA, catch a rebound and move higher from that point on, so far so good. But I would say if we lose the top of the bearish engulfing candle, which would be at around the 50 MA at that point, then more likely than not, we're going to lose the 20. So the 50 MA becomes really imperative as a hold when it comes to support. Otherwise, we could get a confirmation that this was a trap. Furthermore, when we clean up the chart, the NDX, we're still using the NASDAQ 100. Can we argue that this is a pattern of a lower high? And if that is the case, then again, the conversation for trap is revived. And if we zoom out of the chart, we can see that we have seen similar patterns before of lower highs. And then the market continued to go down. So maybe this explains why a lot of folks are not buying this rebound. Anyhow, we look at the IWM, the Russell 2000. What do we see here? This is a daily chart using the Bollinger Bands, using the 50 MA in blue, using the 20 MA in white. Now talk about confusion. The dollar is up, bond yields are up. A lot of folks are talking about, okay, it's going to be a trap because we opened this week and you see equities going down, responding to the signal from the dollar and bond yields. But if you believe that the IWM small caps are a leading indicator, on Friday we actually got a positive closing, not by a little, but by a lot, and closing above both the 20 and 50 MAs. So if you believe that the IWM is a leading indicator, then equities should be moving higher. So I would place the dollar and bond yields in the bearish camp. I would place the IWM, the Russell 2000, the daily chart, in the bullish camp. And we also have the VIX. We'll talk about that in a minute. But we look at the weekly chart for the IWM, the Russell 2000. Once again, we're above both the 50 and 20 moving averages. So once again, that's bullish, not bearish. We'll look at the Dixie, an hourly chart. What do we see here? We talked about the inverse head and shoulder in Discord. We caught support from where we're supposed to catch support. And then we got the breakout. And now it appears that the dollar is consolidating in a bull flag pattern. And if it continues to move higher overnight, we're going to have a problem at some point here, whether the algos respond right away in the equities market or during the session. We'll look at the Dixie daily chart here. What do we see using the Bollinger Bands and the trending line? What do we see here? We got a rebound from the 20 MA, a big one. We got a recapture of the trend line once again, and the chart is challenging the highs. So this is bullish, not bearish. And if the dollar is bullish, shouldn't equities be bearish? This is the mystery here. This is the dilemma, and this is why folks are doubting the rebound that we got this week. We look at the weekly chart for the Dixie. What do we see here? It is facing the resistance of the 50 weekly moving average. It acted both as support and resistance before. Now, if we have a closing above this line by the end of the week, then we have a confirmation that the dollar is going to break out big. And again, how long can we play this game? Oh yeah, the dollar is moving higher, bond yields are moving higher, but the equities market is ignoring all of that because of AI or because fill in the blank. They're going to run out of time here, folks. And we have to look at the old man gold because the dollar was up big on Friday, but even gold did not really register a proper response by moving down big. It is still consolidating right now, and we can argue that this is a bull flag consolidation pattern, and gold will move higher. If that is the case, then maybe the fake out operation was the dollar and yields moving higher, and they should be moving down this week. Here's the problem. You know what's going on with energy inflation. It is just a matter of time before we get a report indicating that inflation is going higher. What do you think the response would be by the dollar and bond yields? They're going to go higher. So it's inevitable right now, folks. We're running out of time. In the bearish scenario for gold, we can argue that maybe we're seeing an ABC pattern. If we sustain a lower high here, we can see an inverse ABC pattern. Furthermore, we look at the weekly chart for gold. What do we see here? We have a series of higher highs and higher lows. The question now becomes, are we starting to form lower highs and lower lows? If that is the case, then gold is going to flush down along with equities and the dollar is about to spike higher. We look at silver, SLV. What do we see here? Daily chart. We got the breakout from the bull flag, but it faced resistance and reversed right away. And recently, silver has been a spot-on leading indicator versus gold. So if we look at silver here, are we seeing a pattern of a lower high? We see it in gold. We see it in equities. If that is the case, then they're going to go down. And then we see the dollar and yields moving higher. And it was indeed a trap this week. We'll look at Brent oil daily chart. What do we see here? We got the breakout from the inverse head and shoulder. If you happen to be bullish in oil, you should be satisfied with the results from this week. We see the bullish momentum now resuming. The problem is, if we plug in the Bollinger Bands, we're getting a little excessive here in a short amount of time. We need to cool off a little bit. And I would say so long as we don't lose the 20 MA, so far so good. We get a rebound, cool off a little bit. We get a pullback, cool off for a little bit, and then rebound higher again. Look at the daily chart for the 2-year yield. What do we see here? Initially, it went down. So we saw the bear flag playing out, but then came the reversal right away, forming yet again a higher low, indicating not so fast. Don't assume that the job is done, that the Fed has won, because the labor market is going down a little bit. The labor market is weakening along with a revival in inflation. Once that starts to sink in, we're going to see yields significantly higher, and the equities market will not be able to fight that. Look at the hourly chart for the 10-year yield. What do we see here? Look at the breakout on Friday. It erased pretty much the entirety of the losses throughout the week. Big pop higher, capturing 3 support lines. At least formally, now once again support lines. And maybe we go higher and we close the gap for good. If that is the case, I don't think the equities market will be able to hold here or brush this off as, oh, this is bullish steepening. This is bullshit steepening. Because as the yield goes higher in the 10-year, we have to trim the valuations down. Keep that in mind. We look at the daily chart for the 10-year. Bouncing once again from the trend line. It appears that we got negative divergence on the RSI, but are we about to break that? If that is the case, once again, then it was a trap in the equities market this week. But there is a bearish case for the 10-year yield. Are we seeing a rebound in what could be an inverse head and shoulder pattern? Do you understand how pivotal this week and the week after that will be? Do you understand how pivotal the month of September will be? We must have a resolution here. One of these two is lying. Is it the equities market or is it bond yields? They cannot go higher together. And the line in the sand here is 4.20. Ironically, 420. We close above that. There is no head and shoulder pattern. And we have higher highs to come. And that's going to rattle the equities market. Look at the VIX. Look at this. Crashed this week. Lost support. Lost the gap. And one would look at this and say, okay, this is a bullish sign that the reversal, the rebound is for real. We should be buying stocks right now. I read a report by JP Morgan that says that this is a sign of complacency. So once again, this week is really important. Was the action that we saw in the VIX this week complacency or a confirmation of the rebound in the equities market? We're going to get the answer. And you know where I stand. If the dollar and yields continue to go higher, the equities market will go down. You can't stretch it for too long. Look at Apple, the big kahuna on hourly chart. What do we see here? Significant progress for Apple this week, and it was the kind of week where you can pull this off. Low volume week, holiday trading week, So we see the shorts covering from the drop that we got post-earnings. We see some dip buying here, and Apple reclaims 181, 185, and even 188 as supports. The problem now is the hourly chart is overbought, so it's going to become really sensitive to any sell order, to any pop in yields, to any pop in the dollar. We look at the daily chart for Apple. What do we see here? On the bullish side, we're above the 20 moving average. We're also above the 50 MA. But then we look from the bearish lens and we see that we have a divergence outside of the Bollinger Bands, number one. Number two, we see that the chart filled the gap and now we no longer have a gap fill, which means the chart is now ready to go down. We look at Apple weekly chart. What do we see here? If this is indeed a trap, a low volume rebound, then we could be seeing an inverse ABC pattern in the play here, which will take us down to form lower lows. How about Tesla, the souffle in hourly chart? What do we see here? You can see that my markings from the morning brief in Discord is still here. I told you we have to go down and revisit this trend line. Indeed, we got down. We got a bounce. And you look at the hour side, we're kind of oversold here in the hourly chart. So can we see a rebound? Sure. The problem becomes if Tesla loses this support line, and the confirmation would be losing 240. Why do I say that? If we go to the daily chart, what do we see here? You got the Bollinger Bands, you got the 20 MA in white, you got the 50 MA in blue. This is a daily chart, not a weekly one. It appears that we got a clean rejection from the 50 MA. The confirmation will be losing the 20 MA. If that is the case, you got to go short Tesla with both hands because we got a confirmation, rejection from the 50, confirmation of losing the 20 once again. And last but not least, what about Bitcoin tulips? What do we see here? The answer is nothing at all. We have a bear flag consolidation pattern. We got the anomaly, the pop. You can say this is because of the SEC grayscale news. You can say that this is because the dollar went down throughout the week and then popped higher on Friday. Whatever the theory is. The bottom line is we did not close above 26,555 and maintain that as support. So if this is a false breakout, charting analysis tell us that the actual breakout would be in the opposite direction, which means Bitcoin is going to flush down. Honestly, I have no dog in the fight here. I would say if it goes above 26,555, you're not going to trust it now. It needs to give us another support line, which is 29,200. Otherwise, I'm not going to trust it. I'm going to assume that we're going to go down instead. And once again, this is why this week will be decisive. So let's move on to the conclusion of this video. What do we have on the economic calendar this week? Tuesday, the 5th, we have factory orders. Wednesday, the 6th, we have trade deficit. We have the services PMI, and we have the Fed Beige Book. Thursday, the 7th, we have initial jobless claims. We have productivity and unit labor cost. And look at this. We have a bunch of zombies from the Fed, from Philly, from Chicago, New York, Atlanta, Dallas. So this is going to be really important. What are they going to say? Are they going to drum the beat that, the labor market is cooling off, so mission accomplished, maybe September is not going to be live? I would not say that, but I know they're pumpers. I know that Bostic is a pumper. We know that Goolsby is a pumper. Even Harker from Philly lost his mind. So we have maybe John Williams. Maybe he's going to lose his mind this week. And then we got Logan from Dallas. What is she going to say? You don't want to be a Fed president on TV coming out saying, yes, mission accomplished, the labor market is down, and by the way, September is going to be off the table. Then comes next week and you get a hot CPI reading, and then what? Pie in the face, now you have to raise rates in September. So keep that in mind. Friday, the 8th of September, we have wholesales inventory, consumer credit, and another zombie from the Fed, this time around from San Francisco, Mary Daly. With that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
They called it Black Monday. No shit. By 4 p.m., the market had dropped 508 points. The biggest plummet since the crash of '29.